Mahoney Asset Management CEO Ken Mahoney and Strategic Wealth Partners VP Tony Zabagala. Guys, I think you're both old enough to remember Mr. October, Reggie Jackson, the New York Yankee. He signed the richest deal in baseball history in 1976. It was $3.5 million. People went crazy for just 5 years. Well, he delivered 4 AL East titles, 3 AL American League pennants, 2 World Series. And the reason I'm bringing this up is investors now expect the richest companies in the stock market to keep delivering the home runs, and they stumbled a little bit this week, Ken. I mean, can they do it? Can the Big Five keep going?
Yes, the hunt for Mr. October, Reggie Jackson. I still have those candy bars. Probably don't taste so good now. Look, we're having a stealth correction. Let's be straight here. I mean, we have the leading averages, Dow, S&P, NASDAQ kind of holding up. Underneath it, it's been a lot of carnage. I mean, small caps been selling off. Biotech's been selling off. This week, one of the leading sectors is utilities. So there is kind of a risk off, yet money continues to flow back to large cap growth. I mean, we love large cap growth. Hanging in there pretty good. The trillion club becomes a 1.3 trillion club or the 1.5 trillion club. So I think Mr. October is okay, and I think we're okay staying in this lane, which is large cap.
Tony, you feel the same way?
Yeah, you know what? I think the bar is set so high for Q2 earnings right now. The Street's expecting more than 60% earnings growth, and that is the second highest percentage ever. This earnings season is shaping up to be very similar to Q1, where we're getting big beats and raises, but no price movement, suggesting we've pulled forward a lot of future gains. So I'm, again, expecting minimal price movement or even sell the news kind of activity as we continue through this earnings season.
So now that is frustrating. It was frustrating for the first quarter. It's already been frustrating for people who were loaded up on banks coming into this week. But doesn't that also, Tony, skew or at least make the PE ratio? I'm not a big PE fan, but I know Wall Street is. So you got the pricing, you got the earnings part of this. If earnings keep rocketing higher and prices drift lower, at some point, doesn't that make the market very attractive?
So, you know, I wish I had a crystal ball, but I'm going to go out here on a limb and say that, you know, tapering starts, you know, probably sometime at the end of this year or next year. And based on the last taper tantrum of 2013, financials and healthcare were the 2 best performing sectors 6 months before tapering started. Financials, they've been great so far. They're already basically at all-time highs. So I consider them to, you know, just continue to tread sideways. So I expect healthcare to take the lead for the rest of this year. Intuitive Surgical comes to mind. It's a good company that we own for our clients.
I love Intuitive Surgical. I started buying it maybe 15 years ago. By the way, I was told you had a crystal ball. So, Ken, let's talk about this earnings season for a moment. You know, I hope it's not a redux of last time. I don't think it will be. I think banks this week were a special case. I do believe, you know, Tony was talking about 60%. I think we're going to see companies in 65%, 70%, quarter-over-quarter beats. Are you holding any names specifically into earnings because you think they'll be able to not only beat, but the stock will react positively?
So again, our best idea is still Apple. And by the way, Apple's heavily weighted in the S&P 500, as you know it. Again, none of us really have a crystal ball here. My crystal ball, I think I broke the glass some time ago. But again, you may get a little sell-off, you know, because of the news like we had, remember, last quarter, like Amazon started the morning, pre-market up 35, 40 points. And by the end of the day, down 35, 40 points. You could see some of that, but that's noise because most of those companies regrouped and went higher. So if we do get to sell the news, so to speak, Charles, we'd be buyers of that. I mean, at the end of the day, we are tweaking portfolios for the second half of the year. We still like QQQ is our favorite idea, the NASDAQ 100. But after that, again, what you guys just said, healthcare, think about it. It is a good hedge against, God forbid, the variant of this disgusting, you know, COVID we've been dealing with. FHLC, that's a Fidelity ETF, that holds companies like Moderna, Pfizer, companies like Regeneron. These companies are battling the COVID. That's the way to play that, along with kind of consistent growth that they should have with or without the COVID.
Tony, are you concerned at all, though, about the internals? This week they've been awful. In fact, the last 2 sessions there have been more new 52-week lows on the NASDAQ than highs. And we're talking about the NASDAQ. It's been a juggernaut. I mean, I'm shocked to see this happening. Do you think there's something crumbling? Is the foundation of the rally crumbling at all?
So, you know, Technology is always going to be a lead, especially in a period that we're shaping up to be in the second half. You know, we're up 17% year to date, and that's you know, basically 2 times historical averages. So, you know, and our largest pullback so far in 2021 has been 4.1%. The average inter-year pullback is 13%. So the path of least resistance for most of the market right now is just sideways. However, we have more concerning headwinds, in my opinion, such as clarity on Biden's tax policies, bond tapering, rate hikes. I think any one of those or a combination of all 3 is going to throw the market into a tizzy. We might see a quick correction, but I also see a quick bounce back. That's why we're sitting on some dry powder. We're expecting some type of mini correction, but we're prepared for it.
Oh, okay. And of course, Ken says you want to buy those tizzies. Ken, Tony, thank you guys both very much. All right, well, the work